Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for April 28th of 2024. Start off the chart back this week with a little bit of economic data, get into some investment markets information and some feedback for you there, and then get back into some more economic data I thought was pretty interesting over the reading the last week. We're going to start with first quarter real GDP, and we got those numbers earlier this week. They were lower than expected. Here you can clearly see the market was looking for about 2.5%. Actual numbers were 1.6. And you can see here is going back to the first quarter of 2022, kind of the various components. So we know that there are a lot of things that kind of feed into GDP, into economic growth. And what you can clearly see over some period of time here, several quarters, is consumer spending has been very, very strong in this gray area. And then on top of that, you've got benefits from housing, government spending, and also business investment, where we were really dragging this quarter, and this amounted to about 0.8% or so of drag, was net exports. And so this is a function, as we'll see in a second, of imports being much stronger than exports because the demand and our appetite for consumption remains fairly strong, and so we're just simply not exporting as much as we're importing, and so that leads to an imbalance there. And the other thing too that we saw that was consistent with the prior quarter was lower overall inventory. So inventories were a drag on growth, and usually when you have strong consumer spending and consumption like this, that at some point drags coming from inventories will reverse themselves. And so this trade number can be a pretty fickle number. And so can inventories. And you can see here clearly over periods of time where maybe if you get inventory drags, then you get an inventory boost, and then so on and so forth here, and then eventually you get a boost from inventories here. So inventories can be pretty influential, and I think the fact that they were a drag here over the last couple of quarters sets the stage for a pretty strong number next quarter. And then of course trade is apt to be volatile. We know there are parts of the world like say the UK, which was in a recessionary phase at the end of last year. We know a lot of Europe is kind of like treading along here. So it's not too surprising that export demand from US is not nearly as strong as the import demand is from consumption and consumers here in the US for foreign goods. Well, as we talked about, we have trade and inventories that can be quite fickle from one quarter to the next. And so on the left-hand side, we've got trade contribution to GDP growth. We do have exports in the green, and in the orange here we have imports. And so obviously, if we have a net trade surplus, then we've got both exports and imports move in the right direction. But in the case of this past quarter, where we had imports which far exceeded the amount of exports, then you have a net negative influence from trade. And so you can see here, this is kind of basically a push from the third quarter. We had a little bit of a tailwind from higher exports in the fourth quarter, and then exports really dropped off here. And we know that certain parts of the world, like say UK, was, they were in a recessionary environment at the end of 2023. We know that a lot of Europe, mainland Europe, is kind of treading water right now. And so this is not terribly surprising to see exports in one particular quarter maybe be a little bit soft, but the import number is really indicative of strong consumption spending. But you can see here clearly that on balance from one quarter to the next, net trade can be easily as much of a tailwind as it is a positive. Now, looking at inventories, they can also be fairly fickle, as we talked about in the last slide, where you've had net inventory erosion over a period of several quarters. That usually leads to a period like say here where you get a boost, and then down here where inventories drag again, and then at some point you get a boost. And so that's likely to happen here in the next quarter or two. Now we'll look at some other elements of the GDP report. We've got consumer spending on the left-hand side. You see spending on goods was actually a little bit negative, which is little interesting. We'd seen positive good spending here lately, but good spending was negative in the last quarter, but that was more than made up for by strong services spending, which we know still has an inflationary component to it. So overall total consumer spending was very strong. Again, not necessarily as strong as it had been, but that's only because we had a tailwind of good spending here that we didn't carry over into the most recent quarter. And also, when you look at businesses, their investment is also important. Overall investment can be inventories, it can be business investment, it can be quite a few things, but we still see some strength here from business investment overall as a contributor towards overall economic growth. Here we have a PCE number. So we've been tracking this. This is the Fed's preferred gauge for inflation. And I'll just kind of leave this as the all-in PCE number. We won't get into the nuances of the core, which that number was actually almost right on top of the estimate here. So, we've been tracking about 2.5% on PCE inflation. That did pick up a little bit to about 2.7%, and that's about where the core PCE is as well, about 2.7, 2.8%. So, here clearly we saw, like a downtrend kind of leveling off, which is not terribly scary in my opinion. I mean, this happened just last year where, we felt like we were losing traction in inflation. And then that picked up again, the deceleration or the disinflationary elements began to really take root towards the end of 24. And this is where we felt like, oh, great, we've won the war against inflation. So here come the interest rate cuts. Well, guess what? We hit 2024 and it flat lines and then it actually moves back up for over a period of a couple months. And so, we're just going to have to be patient because I think this might be indicative of another kind of a period of stasis here. Now, a lot of people are worried about stagflation. I don't necessarily see that because I see the overall trend line here is down. Now, if this gets stuck here in the 2.5 to 2.8 range for a few months, it's going to probably cause some consternation in the equity markets as people feel like, all right, we've fully taken off interest rate cuts out of the forecast for 2024. And if you couple higher inflation with slower growth, which may be something that we talk about a little bit more in the coming months, and that kind of sets the stage for stagflation. I don't necessarily see that right now, and I just don't want to get too bent out of shape here, on these inflationary numbers right now, because we do know, like in the core sense, rents are very important, as are wages, and we do know that wages are high, but they have come off their peak, and we do know rents, and we've got a slide a little bit later that again confirms what we've been talking about consistently, is that realized rents are actually going down, but the owner's equivalent rent calculation is works at a lag, and it's just going to take a while for that to kind of pair up. A quick comment on bond yields. Right now we see the 10-year Treasury moving higher in response to the in not only the inflation data, but also the lower GDP data, feeling like, economic, the backdrop is slowing a little bit. We're not going to get those rate cuts that we thought we were. And so this higher for longer seems to have set in. And so you can see here very clearly, this uptrend as we've gone through the first few months of 2024. And a little bit of an acceleration here. That's obviously going to drive mortgage rates up. So now we're about 4.7 on the 10-year when we were, below 4 coming into the year here. Now we'll talk about the equity market. Here we have a trend line of the S&P 500 in the light blue, and then we have the 50-day moving average superimposed there in the darker blue. And in this chart from Charlie Bolello, you can see here very clearly that this is the first time that we've closed below the 50-day moving average since last November. As we'll see in a second, this is a pretty impressive trend that we've been able to trade above our 50-day moving average. And even though it seems like, okay, well, that doesn't strike me as a very long period of time, it actually is, relatively speaking. And we'll talk about, kind of market volatility that typically, holds in an average year, and the fact that, we've seen pretty abnormal kind of low volatility for a regular market environment, if you will. So this chart has a lot of data on it, but in this shaded area, this period from last November, where we've been trading above our 50-day moving average, actually ranks number 10 in terms of the longest duration of trading above its 50-day moving average. And you got to go back, you see here like 96, 58, 61. I mean, you're going back a long ways. And this is the oddity of this whole market, is that we've traded above the 50-day moving average for 162 days. Now, obviously that's snap now, but we've had an overall 17.6 gain in the market. And so what Charlie Bolello here is doing is he's going back on these other time frames and looking at what performance is in the market looking forward after that streak is broken. So and it really is a mixed bag. And in the case of like 3 to 6 months, you've got a few instances where the market was actually down, but the majority of observations here is the market was up, and in some cases up by pretty profound levels. And then when you get into 1 year, still there's a spattering, but 3 to 5 year returns are on balance extremely good in this circumstance. We talk about PE ratios and talk about earnings, and we look at the market correction here over the last several weeks, and it really has been a correction. When we had the S&P 500 is 5.5% off of its peak, and as we can see here, most of this has been a result of multiple compression, because you see earnings overall in this orange line, and they continue to move higher, and then what we see is the PE ratio having come down. And so this is symptomatic of multiple compression, and that's exactly what has happened in the market. So think of it this way, that the S&P 500 is trading down is not because earnings are going down, it's just because the multiples are compressing a bit right now. Here we have the earnings yield for the S&P 500. You can see that this is actually subtracting out the 10-year government yield. And so what's really interesting here is a dynamic that we don't see a whole lot. Now, we haven't seen this since, basically 01, 02 and the tech bubble and the ensuing brief recession, but the much larger bear market. We haven't seen that since then, but we're actually negative. So if you take the S&P 500 earnings yield and you subtract out the 10-year treasury yield, which we just showed you, has moved higher, then you're actually negative right now. So there's not a risk premium per se advantage in the market right now, which is another reason why the equity markets have been soft here. And we know that bond yields are pretty attractive. And so when you have that case, then in a lot of instances, market says, hey, I can get a better deal with less risk necessarily in the bond market than I can, for the time being in the stock market. And that is a little bit of the sentiment right now. Here's a chart I think is extremely educational. So 5% pullbacks in the S&P 500 are actually fairly common, and they generally happen 3 times a year. And you usually get like a 10% correction, usually about once a year or so. And so we've had years where we haven't had that kind of correction. Now, obviously, we just have had that in the S&P 500, but you can see the average number of 5% pullbacks are about 3.4, going back to 1930. And so I just want to, we've enjoyed a period of lower volatility that has kind of seemingly been snapped over the last handful of weeks, and just, say that is actually kind of par for the course here. Here we have volatility in the index. This kind of goes hand in hand with, some of these corrections that we just showed you in that last chart. But, volatility on balance has been very low, actually looking at over the last 9 months. And we've had a little bit of spike here, in October. And you can see here very clearly that we're spiking again. But on balance, that just kind of gets us back to kind of an average or normal level of volatility as defined by the VIX here. So again, a lot of this is like normalization. Now we'll look at corporate profits. We can see here that this is kind of the mother's milk, as is sales. Sales is the primary mother's milk for corporate profits, and then profits is a manifestation of that. But you can see profit margins are exceptionally high. They're well below their long-term average. This has fueled a lot of a lot of long-term enthusiasm on stocks because you've had this general uptrend, which, again, if you go back, I mean, we're talking like, 20 years almost here of expanding profit margins. Here we have some data broken out a little bit differently from Hussman Advisors here. And where you can see here, again, long-term trend is, we've got a general uptrend here, but that uptrend is about 7.5-ish. And you can see that, basically, however you define profit margins, whether it's on reported GAAP earnings, whether it's on operating earnings, or whether you're looking even at forward earnings, that you actually, you're looking back over 2005, again, almost 20 years here of expanding profit margins in a way that we just haven't seen in the market in the past. It's a very interesting plot here, and I'll try to be clear in my explanation. So on the x-axis, we have forward operating PE for the S&P 500, the forward operating price to earnings ratio. And right now we know that as of the end of March, we're pretty richly valued. And again, this is on forward estimates. So we're above 20, like we're around 21 right now. And then you plot that against the y-axis, which is the actual subsequent S&P 500 10-year nominal return. So this is just saying, based on the earnings multiple that you're trading on right now, what is the probability of return looking ahead 10 years? And so it seems intuitive. If you have a low multiple in the market, again, the average multiple is about 15.5, 16, that's going to put you up here in the observations of data. So basically, if you have an average PE of around 15, 16, which again, long-term average there, then you're going to return anywhere between like 8.5 and 14% a year. And I don't mean to sound like a Debbie Downer, but the one thing that we've got to guard against is, because we have a relatively high multiple right now, that sets the stage for a pretty low return environment over the next 10 years. Again, this could change, and we know that it's heavily influenced by a handful of the large mega stocks, and if you take those out of the equation, then your multiple is somewhere in this range, which puts you here. So I think that if you back out the high flyers, which have been taking it on the chin a little bit lately, then what that does is probably put you in a 10-year expected return range that's closer to 6 to 8% than the 10 to 14% that would be the long-term average. Here we have another dot plot. Again, x-axis is the largest 50 S&P 500 components. And so this is in red, they're plotting the median price to earnings ratio. And then in blue, they're plotting the median price to revenue ratio over that profit margin. And so you can see here, again, this is a scatter plot, but you have data that goes back a long time from 1984 here. And you can see here where, the largest 50 S&P 500 components and where they're trading. Again, you've got a lot of folks that are in this range right here. And so the subsequent 7-year average annual return is fairly low in that case. And so when you say, all right, well, let's take out the largest 50 and you've got, maybe the valuations closer to here, then you're looking at data that is a little bit more consistent with longer term average. But the problem right now is that you have the largest 50 S&P 500 components that are trading fairly richly right now, but after a 5% correction or so, that has changed a little bit. All right, so another scatter plot, if you will. We've got the 10 largest S&P 500. This is price to revenue, so not price to earnings, but price to revenue. And then this is also one of these 10-year expected, or not expected, but average realized return. And just as we've seen in these other charts, you know, if you're richly valued, then your expected return is pretty low. And so March 24th, on our largest 10 stocks, again, these are the high flyers, these are the mega caps, these are the AI infused names that we've all been talking about this year. They're richly valued. And so at this point, you know, if you look at it on its face, you know, the outlook is not that great for earnings over a 7-year period, or even in this case, a 10-year period. So, you know, this is something that, you know, is rooted in statistics. You know, I don't want to get everyone all nervous and upset yet, but it makes me think that we should be doing what we can to take advantage of volatility when it hits, because that's where your return's going to be more so than just betting on beta and betting on just riding the market. We get into some economic data now. We've got charge-offs. We've been talking about this, the health of the consumer, you know, obviously consumption and consumer spending, as we saw in the GDP figure, was a huge tailwind. However, we do see some stress in the market. You know, we see delinquencies and defaults. Now, this is from Discover Card. These are actually not delinquencies, but these are actually charge-offs. And this is like a charge-off rate. And that number is really spiking. And again, as you go back to the global financial crisis, and we peaked about 9%, we're not there yet, but this is something that we should monitor, because as the consumer, you know, runs into these headwinds where they can't borrow to spend anymore, then they just simply not spend as much. And so I think this helps to maybe set the expectations bar that consumer spending is not going to be as much of a tailwind to economic growth as we've seen here in the past several quarters. Here we have wages. We talked about wages being sticky, and we do see that wages are coming down a little bit. So this is wages adjusted for productivity, and some research that came out of Guggenheim. And so wages adjusted for productivity are coming down. Now they're still high, but again, if you subtract out the productivity, then, you know, clearly they are coming down, and you can see core PCE service ex housing year over year still above the Fed target, but, you know, it is coming down. So I think there is relief on the way, and so I think the best case scenario, or maybe the most average case scenario would be the best way to put it, is that we have the inflation coming down, so we don't get the stagflation element, but we get inflation coming down, and we also get economic growth slowing a bit. So, you know, we talked about inflation, and we've talked a lot about small businesses. A lot of people are kind of taking it on the chin because they can't borrow efficiently. The access to capital and the cost of capital is really expensive, and access is tight. But what we see here from the National Federation of Independent Business, as reported by Bank of America, is that in response to rising inflation, small businesses are able to raise their prices. So, and that's a relatively new phenomenon after a period where they were not being able to raise prices. And, you know, this has become another important problem for them because, you know, we know that some input costs, i.e. labor, are still high. And so obviously companies want to defend their profit margins however they can, and labor is the most significant cost input for most people, especially on the service side. And so it does provide upward bias towards prices here. Here we have some data on rents, as we've talked about, you know, rents and wages being the stickiest components of inflation. Well, we just saw where wages seem to be coming down. Rents here too. So, this is rent for newly signed leases. So this is observed data. This is out there in the market. We're negative. Okay, so that's a well understood fact. Well, here's the contribution of rents to core CPI year over year. And it works at a 9-month lag. And here we are just rolling over. So we've got a long way to fall. This is why I feel like with that and wages kind of mitigating here somewhat and clearly looking as though they're going to mitigate. Now, unless we have some exogenous shocks from other areas that contribute into inflation, like an oil price shock or something like that due to geopolitical issues, then these numbers are coming down. Wages and rents are coming down. I think this provides the feedstock for what everyone's been looking for. We just have to be patient. Talk about housing, just a lot of interesting data on housing here lately, and I'm going to try to run through this. So we have a lot of supply in the market right now. I mean, home builders have been really busy. Home builder indices, sentiment indicators have been strong here lately, and they've been doing a good job of buying down rates. We know the existing home sale market is pretty challenged right now, and housing affordability is really challenged. We'll see that in a second. But here we have supply on the market of new homes very, very strong as of late. Here we have existing home sales. Just like I said, they're still in negative territory. They're clearly off of their low point, but existing home sales are really challenged right now. And it's really a blessing to some degree that we've got home builders that are really being aggressive on new housing inventory, which contributed to the upside in the data in the chart that I just showed you before this. But just, existing home sales are much more important to the overall housing picture, and those continue to be negative. Here we have some Atlanta Fed data here, their index of affordability. And as we look out on the horizon, as we got into the fourth quarter of last year, that's probably about a negative affordability index as we've seen in quite some time. Here we have some of those drivers again from the Atlanta Fed, and you can see here, coming out of the pandemic here, we had this kind of shock where we had, incomes were still going up for most people, but the real issue is that housing prices were out of control. And we do know that they're moving back up. We're up about 5% from their low. I'm not sure if I put that chart in here or not, and then as a result, housing prices went up, but also mortgage rates went up, and so that's contributed here to this overall affordability problem that we now witness in this country. So here we have the 30-year fixed rate mortgage. We've seen it move higher, really close to 8%, but I think this is higher for longer because we've got the 10-year yields that have moved higher on the lowered expectations for interest rate cuts. Now that could change, and this could change as well, but right now mortgage rates clearly affecting affordability to some degree. This is a real interesting chart from Resi Club. Shows you the distribution of mortgages by rate cohort, and you can see here that a lot of people, 26%, still have mortgage rates that are lower than 3%, and those people are not inclined to want to move. They're not inclined unless there's a job motivation that kind of overrides it. They're not inclined to want to get out of that situation now. And then you've got about 45% that have mortgage rates between 3 and 4%, and then everybody else represents above that point. So you actually have a lot of people that are 4 to 5%. So, and even these people, when you have mortgage rates that are 7.5, these people are disinclined to want to move. And so basically what you have here is you've got about maybe 9% of the market that is struggling with higher overall rates, and you've got the rest of the market where there's a really strong disincentive to want to move and have to take on a higher rate. I want to mention apartments for a second because this is usually what happens when you have slower single-family residential construction, is that you have an overabundance of apartments coming online, and that's exactly what's happening this year. So in fact, we're going to have more apartment supply hit the national market in 2024 than we've seen since 1974. And you can see how outsized this is relative to recent history. And you can see here, dating back to the global financial crisis and the aftermath, that really began to start ramping. And this is partially due to economics, easy financing, easy credit, but it also was satisfying a housing demand. But just know that this piece of it is ramping pretty heavily. Another interesting development we see in the market is as offices are being vacated because of work from home, and people realizing maybe we just don't need as much space, and absorption is going lower, vacancies are moving higher, though a lot of investors are taking properties and repurposing them and converting them from office to apartments. And I do think that this is a trend that will really begin to take root. We know that a lot of office investors that have leveraged those investments have a tremendous amount of debt that is coming due. And I anticipate that a lot of their plans and taking them for workouts to the bank will involve this type of activity here, which converting offices to apartments. And you can see that really over the last couple of years, there's been a tremendous shift in sentiment there, and also a tremendous expansion of activity. So I'll end on this one. I thought this was a good one to end on, and it's looking at the effective Fed funds rate. We know the Fed's been on hold for a while, but commercial banks and really struggling to right size their balance sheets. A lot of these banks, particularly in the small to medium sized market, as we know, mismanage their balance sheets, and when rates went up, they were put into a bit more of a liquidity issue, and they've been really slow to raise their rates that are being paid on savings accounts. In fact, you struggle right now on a national basis, and this is data from FDIC, that these banks are even paying 0.5%, which is really ridiculous. And so this is one of the things that's causing, goes to the old theory of you can bite your nose to spite your face, and so banks are trying to preserve their profits, because they're obviously charging more for their loans, which are their assets, and their deposits are their liabilities. So they charge less they pay less on their liabilities, so they can improve their profit margins. But they're also witnessing a huge disintermediation as people pull their money out of banks saying, I want more than 0.5%, and they're going to money market mutual funds that are paying basically about 5%. And so that's the issue that banks face right now. And as long as this chart kind of holds with banks being really stubborn on their passbook savings rates, you're going to see money market mutual fund balances remain very, very high. That's all we've got for this week. Hope you've enjoyed the chart pack, and have a great week, and we'll talk to you again soon.